It's finally happened. We've got a tax case going to the Supreme Court. Hi, I'm financial planner Sean Mullaney. Let's discuss. So for those of us who do tax planning, this is a very exciting development. The Supreme Court rarely takes tax cases. And so this case, it's captioned Moore versus the United States. And this is one of those, when you peel back the onion here, it just gets crazy. Interestingly enough, the amount at line in the case is about $14,000 of tax. But in terms of the follow-on ramifications for both corporations and individuals, this could be billions of dollars of tax are on the line in terms of the ramifications from this one particular case. All right, so what are we talking about here? We are talking about a tax that dates back to late 2017. It comes from the Tax Cuts and Jobs Act. And it mostly deals with corporate tax, not individual tax, although this case is an individual case, and the knock-on effects could be very big on the individual side. All right, so think about, just a level set here, think about a U.S. multinational corporation. You're probably aware most of them, especially the large ones, have dozens, if not hundreds, of foreign subsidiaries because they do all sorts of things overseas. They sell overseas. They manufacture overseas, right? These companies today are mostly global, and so they've got foreign subsidies. And for many years, the U.S. had sort of this odd tax system. It's like, well, what do you do with the earnings of those foreign corporations? And the U.S. basically said, well, look, for most of the active earnings of those foreign corporations, we will not tax that to the U.S. headquarters until the foreign subsidy or subsidiary pays a dividend back home to the U.S. headquarters, right? That was generally the rule. That was called deferral. Basically, foreign subsidiaries used to act like an IRA. Like you have deferral, but once you take the money, you're taxed on it. But the big thing was there were no RMDs from those foreign subsidiaries. So there was this big incentive, sometimes it was referred to as the lockout effect, right? If I'm making money overseas, I'm a U.S. company, I'm making money overseas, why the heck would I pay a dividend home and suffer U.S. tax? If I just keep the money overseas, I don't pay that U.S. tax, right? So that's the lockout effect. It was like, look, you're a U.S. multinational, find something to do overseas with it. Don't pay a dividend home, suffer tax. So that meant fewer jobs in the United States. It meant fewer dividends in the United States, fewer equipment purchases in the United States, right? That was deleterious. So they said, you know what, we're going to change our corporate tax system. And late 2017, they said, well, going forward, we're going to go to an exemption system where for the active earnings, most of those, you can just pay the dividends home and we're not going to assess tax on that starting, generally speaking, in 2018. All right, well, that combined with a big corporate tax rate cut to bring the U.S. in line with international norms from a corporate tax perspective costs a lot of money. So they said, we used to have deferral on those old earnings. Well, this new tax system basically makes that permanent exemption. So what we're going to do is we're going to do a one-time tax. It's found in Section 965. I'll link to it in the description below. It's complicated, but basically what it said is it's going to look at the foreign earnings for the last 31 years, and we are going to tax those at a reduced rate. We're going to basically deem a dividend of all 31 years of those foreign earnings, and U.S. multinationals will pay a significant tax on that. But it was sort of thought of as like a fairness thing. Well, they've had deferral for 31 years. Are we going to make that permanent exemption by this tax law change? And oh, by the way, to fit the round peg into the square hole, you got to, from a budget perspective, Congress needed to find some revenue. So they said, well, we're going to tax these corporations. And in fact, I polled, and I'll link to them below. When this first got enacted, U.S. companies had to estimate for their financial statements how much this was going to cost them in tax. I've got 3 estimates from back then. These companies may have revised these numbers. I didn't check if you want to dig. But just to give you an idea of the scope and scale of this, Google Alphabet estimated that the repatriation tax was going to cost them $10.2 billion. Microsoft estimated $17.9 billion. Apple estimated $33.6 billion. So we're talking about some real money here was on the line. Now, these companies were given the option, and most of them, I think, took it, to pay that tax over 8 years. So a lot of this tax hasn't even been paid yet. But, okay. So there's this case, Moore versus the United States. It's filed out in the Ninth Circuit. And, these two people, Charles and Kathleen Moore, married couple, they own something like 11 to 13% of a small Indian company. This company made farming equipment for, lower income farmers in India. And basically, they are being assessed this tax because of that interest in this Indian company. And it's going to cost them something like $14,000. So they paid the tax. And then they said, you know what? That doesn't look right to us. We're subject to income taxes. We didn't get any money from this Indian company. Apparently, they've never gotten a dividend from this Indian company. So they said, heck, we'll pay the tax and then file for a refund with the IRS. And the IRS said, well, you owe that tax. Guess what? We're not going to give you that refund. So what the Moores did is they went to district court and they sued the IRS for a refund of that $14,000. And their theory is that this repatriation tax is not an income tax. And frankly, I think it's a really good theory. I think the Moores have some really good arguments. You have to look at, why can Congress issue an income tax? Because of the 16th Amendment. The 16th Amendment says that Congress can assess a tax on incomes. And so the question becomes, well, what the heck is income? And, there are different cases from the Supreme Court and other courts on this. It boils down to a formulation that's something like this. Income is generally a gain realized, right? So to my mind, it's two elements, right? One is gain and two is realization. What is a gain? A gain is just an increase in the value of something. Maybe it's a salary that you got, right? So you went to work, they paid you $3,000. That's a gain to you. What if you own, let's just go back to Apple, right? So you buy Apple stock for, I have no idea what Apple's trading for. Let's just say it's $500 a share and you hold it in your brokerage account. And, in the markets, it goes to $600 a share, right? You now have a gain, right? Now, here's the thing, though. There is a second element, and it's called realization. So, yeah, you had a gain in that Apple stock. It went from $500 a share to $600 a share. Well, when are you income taxed on that gain? You're only income taxed on the gain when the gain is realized, right? When you go to work, get money from your boss, you've now realized it. So you had the gain of the $3,000 in salary plus the realization. You got the $3,000 in salary. It's in cash. You're taxed on it. Apple stock, you bought it at $500. It goes to $600. You're not taxed yet, even though you had the gain, but you are taxed if you go and sell it for that $600. Now you've realized that $100 of gain. You had gain that was realized. You're taxed on it. All right. Well, let's apply this to this repatriation tax. The Moores didn't receive anything. They just still have that 11% interest in this Indian company. They had no power to get the 31 years of their share of the earnings of this company, right? They're minority shareholders. I would argue that the Moores have no gain, right? They just own this interest in this Indian company. Maybe it's gone up, maybe it's gone down. But even if they do have a gain, it's not based on the earnings of this company. It's just based on what a willing buyer would pay for it. So maybe they do have a gain. I can't say definitively they don't have a gain, but if they do have a gain, it's not the earnings. Apparently it's from, in their case, they invested in 2006. So they have like 13, 14 years of earnings that are being taxed. But here's the real kicker is they don't have a realization event, right? They didn't receive anything. They didn't sell anything. And so I think as applied to the Moores, this is not an income tax. And frankly, as applied to those large multinational corporations, it's not an income tax. What I'm going to do is I'm going to link to two what I find convincing documents. One is a document that is a dissent. So just here's the history of this case. They sue in district court. The Moores sue the IRS. They lose, right? So then they appeal to the Ninth Circuit Court of Appeals. and they lose their appeal to a 3-judge panel. That's typically how these things are done. And so the next appellate step was to ask for all the circuit judges in the Ninth Circuit to review it. They call that en banc. So they said, well, all right, you guys go, could we appeal this to everybody, not just these 3 particular judges? And the Ninth Circuit said, nah, we're not going to hear that, right? We're just going to stick with those 3 judges. They have the right to do that. That happens, I'm guessing, a whole host of the time, right? But in the denial of the rehearing by the en banc Ninth Circuit, there's a great dissenting opinion. I'm going to link to it, and it goes through all the legal arguments as to whether or not this is an income tax, and I find those arguments very compelling. Separately, there is a brief from the Cato Institute. They filed with the Supreme Court, as they call it amicus, right, friend of the court. Hey, Supreme Court, this is an important case. You all ought to take this. And ultimately, the court decided to do that. So that's where this is now. Where it's now is, at the end of the current term, the Supreme Court has said, okay, we are going to hear this case. So this will be litigated in the Supreme Court. And look, this is very speculative, right? I don't know what ultimately is going to happen. I find the dissent in the Ninth Circuit that said, look, we should rehear this because the Moores are right and the circuit court made the wrong decision here. The 3-judge panel made the wrong decision. So I think the Supreme Court's ultimately going to side with the Moores. I wouldn't bet money on that proposition. All free predictions are wrong, or guaranteed wrong, or your money back. I think it's, look, I doubt it's going to be a 9-0 decision, but hey, you never know. I think anything's sort of possible here, and I could sort of see this going both ways. If gun to my head, I think the Supreme Court will side with the Moores, but who knows? I find the dissent in the rehearing, the Cato amicus brief, both of those, I find those very persuasive. It's interesting because this is going to, well, one, if the Moores win, this is a big windfall for corporate America. I mean, I went through 3 companies and we're well over, I think that's easily over $50 billion in tax, actually closer to $60 billion in tax for just 3 companies. Think about that, right? So the Treasury might have to cough up some money. Now, actually, a lot of this money is yet to be paid, but still. There's a little bit of an issue about some of the money that's already been paid. That would have to be litigated too with those, as the statute of limitations run. I tend to think not, because it's not an income tax. So it may be the case, who knows, but it may be the case that the court would say, well, you're not subject to the statute of limitations if the statute is run on some of those payments, because it wasn't a valid income tax. So the IRS isn't protected by that. We'll see. Who knows? I'm just doing some initial speculation there. But this could have all sorts of knock-on effects for individual taxpayers. First, you may have a situation where there's some in Congress, Elizabeth Warren apparently, some others, who want to do a tax on billionaires. Ostensibly, it starts on billionaires, but basically a tax where you'd say, well, billionaire, you invested in, startup company, it's now worth billions of dollars. They call it mark to market that. It's basically a wealth tax. And I don't think that tax is valid as an income tax. But here's the thing. This case could decide whether or not that future tax is valid. Look, my card's on the table. I do not want anybody, I don't care how rich you are, to be paying a wealth tax. Right? It's bad enough we report our income to the IRS every year. Can you imagine a system where Americans are also reporting their assets to the IRS every year? That is not going to be good. And it's only for the billionaires. Nope. No, that's a do not touch with a 10-foot pole. I don't care if it's only assessed on trillionaires. The U.S. does not want that tax. Okay, so it'd be nice. This case could sort of cut that off at the pass and say, yeah, that's just not a good income tax. The way they write this ruling, if it's for the Moores, could basically put the kibosh on that. I think that'd be great. All right, but what about some other things in the Internal Revenue Code? Well, let's start with things that are sort of income taxes, but sort of not. I don't think this would negatively affect the 10% early withdrawal penalty from retirement accounts, because it's sort of a penalty. They call it an additional tax, and frankly, it is on an amount realized. It's an amount that was realized from an IRA. So I think even if the Moores win, that tax, the 72T tax for early withdrawals from a retirement account, that tax is going to be fine. But a few things might not be so fine. For example, there's an excess contribution tax. So there's a tax on making an excess contribution to an IRA or a Roth IRA and not withdrawing it. It's a 6% tax. That tax could be in trouble if the Moores win this case, which they very well might, because it's a 6% of the contribution amount. Well, that's not an income amount. Nobody realized income. So I think that tax could be revisited, and that tax could be in some trouble. There are other taxes. There are prohibited transaction taxes in the qualified plan world. You have to see how they're measured, but if they're not measured based on some sort of an income event, I think those could be challenged. I haven't really dug into those, but I'm just sort of speculating out loud. So I think there's a lot of things here with this Moore case. It's going to be decided in the next term by the Supreme Court. So sometime from October to June of 2024, much more likely to be closer, if not in June of 2024. There'll probably be oral arguments probably in the fall or the winter on this. So this is a fascinating development. It's called Moore versus the United States. Now, apparently there's another Supreme Court case, Moore versus the United States. So you got to do Moore versus the United States and Section 965, which is the tax at issue, just to make sure you get the right case. Stay tuned. Let me know what you think in the comments below. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.